Your phone buzzes at 5 a.m. with a red alert you have never seen before. Every major network is running the same banner across the bottom of the screen. Emergency session called after overnight chaos in the United States government bond market. Somewhere in Denver, a mortgage broker named Sarah Whitfield rolls over and grabs her phone. She has closed hundreds of home loans over the past decade, but nothing in her career prepared her for what she's about to read. Overnight, a handful of the world's largest foreign holders of American debt started dumping their positions. Not slowly, not quietly, but all at once in a matter of hours. Japanese institutions, the single largest foreign owner of U.S. government debt, began pulling capital home. Pressure had been building for months as their own currency strengthened and domestic yields climbed. Chinese state banks, already trimming their holdings for years, accelerated their retreat overnight. Analysts had been calling this shift the sell America trade since the start of the year. It was never one single headline that caused it. It was a slow erosion of confidence that finally reached a breaking point. For weeks before this morning, Treasury auctions had been quietly struggling. 2-year, 5-year, and 7-year note auctions all drew weaker demand than expected. Traders noticed but brushed it off as noise. Central bankers noticed and stayed quiet in public. Then, overnight, the noise became a siren. Bond prices collapsed within minutes of the Asian markets opening. When bond prices fall, yields rise, and this time they didn't just rise, they rocketed. The 10-year Treasury yield tore through 4.6% before breakfast in New York. The 30-year yield, the one that shapes mortgages and long-term loans, blew past 5%. For a bond market that is supposed to be the safest in the world, this was unthinkable. Treasury securities are the foundation the entire global financial system is built on top of. Every mortgage, every car loan, every corporate bond references this market in some way. When the foundation cracks, everything resting on it starts to shake. Sarah opens her laptop and watches the futures market before the opening bell. Dow futures are down more than 1,000 points before trading even begins. S&P 500 futures are bleeding red across every sector without exception. NASDAQ futures are down even harder, dragged lower by technology names that had powered months of gains. When the opening bell finally rings, it is not a crash, it is a freefall. The Dow sheds over 1,100 points in the first hour alone. The S&P 500 posts its steepest single-day decline in years. The NASDAQ tumbles even further as investors abandon anything considered risky. Trillions of dollars in market value evaporate before lunchtime on the East Coast. Behind the scenes, the mechanics of the bond market itself are straining under the pressure. Every week, the Treasury Department auctions off new debt to fund government spending and roll over what's already outstanding. Under normal conditions, these auctions are almost routine, drawing steady demand from banks, funds, and foreign governments alike. This week, dealers who are obligated to step in and buy leftover supply find themselves holding far more than they want. Bid-to-cover ratios, a simple measure of how much demand shows up for every dollar of debt offered, come in weak. Weak demand at auction forces yields even higher. Since the government has to offer better terms to attract buyers, it becomes a feedback loop. Higher yields spook more investors, which weakens demand further, which pushes yields higher still. Breaking that loop is exactly what the emergency coordination among officials is designed to do. The VVX, Wall Street's so-called fear gauge, spikes to a level not seen in years. Traders on the floor describe the mood as somewhere between panic and disbelief. Sarah's own retirement account loses more value in one morning than it gained all year. She is not alone. Across the country, pension funds tied to teachers, firefighters, and city workers take a direct hit. Union leaders start fielding calls from members asking if their retirement is still safe. Financial advisors spend the entire day on the phone trying to calm frightened clients. One message repeats over and over: don't sell, don't panic, ride it out. But panic doesn't listen to advice. Panic listens to fear. As stocks crater, investors scramble for anything that still feels solid. Gold, the oldest safe haven asset in human history, explodes higher within hours. It had already been on a historic run, climbing past $5,000 an ounce earlier in the year. Now it surges again as the dollar weakens and confidence in paper assets erodes. Central banks around the world have been quietly stockpiling gold for years, preparing for exactly this kind of shock. Analysts call it de-dollarization, a slow but steady shift away from total reliance on the American currency. On this particular morning, that slow shift suddenly looks like it is speeding up. The US dollar itself swings wildly against other major currencies within a single trading session. One moment it strengthens as a safe haven. The next, it weakens as confidence cracks. Currency traders describe the volatility as some of the most extreme they have witnessed in years. Meanwhile, borrowing costs across the entire economy start climbing in real time. Banks reprice mortgage rates within hours of the bond market opening. Sarah watches her own quoting system update 3 times before 10 in the morning. A 30-year fixed rate that was already sitting above 6.5% jumps even higher. For a family looking at a $400,000 home, the new math is brutal. Their projected monthly payment climbs by hundreds of dollars overnight. Buyers who were pre-approved just days earlier suddenly no longer qualify for the homes they wanted. Sarah's phone rings nonstop with clients asking if they should walk away from deals already in progress. Existing home sales, which had already been sliding for months, are about to fall even further. Builders pause new project financing until they understand where rates will settle. Realtors across the country brace for a wave of canceled closings. Across the country, total household debt was already sitting near an all-time high before any of this began. Credit card balances alone had climbed past $1 trillion, with families leaning on plastic to cover rising costs. Gas prices had already been creeping toward $4 a gallon in parts of the country for months. Inflation running near 4% had already stretched paychecks thin before borrowing costs jumped even further. Now, with credit tightening on top of all of that, families feel squeezed from every direction at once. A single mother in Phoenix delays replacing her aging car because the auto loan rate she's quoted feels impossible. A young couple in Atlanta puts their wedding on a smaller budget after their credit card limit gets cut. None of these stories make national headlines on their own, but together they tell the real story of the crisis. It isn't just homebuyers who are getting squeezed. Small business owners who rely on credit lines to manage cash flow get hit almost immediately. Banks had already been tightening lending standards for over a year before this crisis even began. Credit surveys showed small firms increasingly unable to get the full amount of financing they applied for. Now, with borrowing costs spiking further, banks pull back even harder. A bakery owner in Ohio can't get the equipment loan she needs to replace a broken oven. A trucking company in Texas has its line of credit frozen pending a full review. A software startup in Austin watches its planned funding round evaporate overnight. Every one of these stories repeats itself thousands of times across the country in a single week. Consumer confidence, already fragile from months of inflation worries and high interest rates, collapses further. Surveys tracking how Americans feel about the economy show sentiment sliding toward levels associated with genuine fear. Families start delaying big purchases, vacations, cars, home renovations, anything that isn't essential. Retailers brace for a slower back half of the year as discretionary spending dries up. Corporate executives start freezing hiring plans they had only just approved weeks earlier. Some companies quietly begin drawing up contingency plans for layoffs if conditions worsen. Meanwhile, the crisis stops being an American story and becomes a global one within hours. European markets open sharply lower, tracking the overnight chaos out of the United States. Asian markets, some of which are still open when the news breaks, swing violently. Emerging market currencies get hit hardest of all as capital rushes back toward perceived safety. Countries that borrowed heavily in dollars suddenly face a much more expensive bill to repay. Oil prices swing sharply as traders reassess global growth prospects in the middle of the chaos. Energy markets, already jumpy from months of geopolitical tension in the Middle East, add another layer of uncertainty. Corporate bond markets seize up almost immediately as companies planning new debt issuance pull their offerings entirely. A wave of corporate borrowing that had been competing directly with Treasury auctions suddenly disappears overnight. Credit spreads, the extra yield investors demand to hold riskier corporate debt, widen sharply within a single session. Companies that were planning to refinance existing debt in the coming weeks now face a far more expensive market. Emerging market currencies from Brazil to South Africa to Indonesia get caught in the crossfire almost immediately. Countries that borrowed in dollars now owe more in local currency terms, straining already tight government budgets. Capital that had been flowing into these markets in search of higher returns rushes back toward perceived safety. Multinational companies operating across borders delay major investment decisions until the dust has a chance to settle. Finance ministers from the G20 economies scramble to organize an emergency call within hours. Central bank governors join a coordinated session to discuss how to prevent wider contagion. This is not the first time global officials have needed to act fast to stop panic from spreading. It echoes the emergency coordination seen during the 2008 financial crisis and again during the pandemic. Officials understand that in moments like this, confidence matters as much as any policy tool. If investors believe leaders have a plan, panic can slow. If investors believe no one is in control, panic accelerates. Inside the meeting, three main tools are on the table. The first is liquidity, making sure banks and financial institutions have enough short-term cash to function. The second is direct market support, stepping in to help stabilize Treasury prices if the selling becomes disorderly. The third is communication, publicly reassuring markets that the system's core institutions remain solid. The Federal Reserve has tools built exactly for moments like this. Standing facilities exist that allow banks to quickly convert their Treasury holdings into short-term cash. These facilities were expanded and tested after previous funding squeezes rattled markets in recent years. Officials confirm they are ready to use every tool available to keep the plumbing of the financial system working. Emergency repo operations begin within the first day, injecting liquidity directly into strained funding markets. It doesn't fix everything, but it slows the bleeding just enough to keep panic from spiraling out of control. This isn't the first time this exact corner of the financial system has needed emergency help. A funding squeeze back in 2019 forced the Fed to step into overnight lending markets for the first time in a decade. Then came the spring of 2020, when pandemic fear briefly froze even the Treasury market itself. In both cases, the central bank's willingness to act quickly kept a bad situation from turning into something far worse. Officials point to those episodes now as proof that the tools exist and that they work under pressure. Skeptics counter that using the same emergency playbook over and over is itself a warning sign worth taking seriously. Every time the safety net gets used, they argue, it normalizes a level of fragility that shouldn't be treated as routine. Regulators push back gently, insisting that a resilient system is one that can absorb shocks, not one that never faces them. That debate plays out publicly on financial news networks for days, with strong voices on both sides. Ordinary Americans watching from home mostly just want to know one simple thing. Is my money safe? And will this get worse before it gets better? Back in Denver, Sarah spends her second day fielding a different kind of call. Some clients want to lock in a rate immediately, terrified it will only get worse. Others want to cancel everything and wait for the storm to pass. She tells all of them the same thing her mentor once told her. Markets overreact to fear far more violently than they ever react to facts. It is a lesson history has proven again and again, even when it feels impossible to believe in the moment. By the third day, the panic begins to show its first cracks. Large institutional investors, the kind who think in years rather than headlines, start stepping back in. They begin buying Treasury bonds at yields far higher than anything available just a week earlier. To them, this isn't fear. This is opportunity. Pension funds and insurance companies that need predictable long-term income start locking in these elevated rates. Their buying doesn't reverse the crisis overnight, but it puts a floor under the free fall. Analysts note that this is exactly how past shocks have eventually stabilized. Fear pushes prices to irrational extremes, and then patient capital steps in to correct the imbalance. It happened after the 2008 crash. It happened again during the sharp pandemic sell-off in the spring of 2020. And slowly, it begins happening again now. Stock markets stop their free fall and start trading in a tense, choppy holding pattern. The VIX pulls back from its extreme highs, though it remains elevated compared to normal conditions. Gold, having already surged to fresh records, settles into a new, higher trading range. Analysts describe this as the market permanently repricing risk rather than simply panicking and recovering. The dollar stabilizes, but doesn't fully reclaim its previous strength. Some economists argue this marks a lasting shift in how the world views American debt. Foreign governments, they warn, will likely keep diversifying away from total dependence on the dollar going forward. Others push back, pointing out that no other market in the world offers the same size, depth, and liquidity. There is no easy substitute for a $10 trillion Treasury market, even one going through turbulence. This tension between structural worry and practical necessity defines the debate in the weeks that follow. Across town, a retired schoolteacher named Robert checks his brokerage account for the third time that day. He spent 30 years contributing to a retirement fund he was told was built on safe, boring bonds. Watching the value swing so violently makes him question a plan he trusted without ever really questioning before. His financial advisor walks him through the numbers slowly, reminding him that his time horizon is still measured in years, not days. Robert isn't the only one having that exact conversation this week. Advisors across the country field the same nervous questions from clients who thought bonds were supposed to be the safe half of their portfolio. Financial commentators start explaining, in plain language, why the old rules of investing suddenly feel less reliable. For decades, the classic strategy split a portfolio between stocks and bonds, trusting that when one fell, the other would rise. That relationship had already been breaking down in the prior year, with both assets sliding together on more than one occasion. This crisis makes that breakdown impossible to ignore any longer. Financial planners begin recommending broader diversification, spreading risk across gold, international assets, and shorter duration bonds. It is a quiet but meaningful shift in how everyday people are told to protect their savings going forward. Meanwhile, the human cost of the crisis is impossible to ignore. Families who were mid-process on a home purchase either scramble to close quickly or walk away entirely. Small business owners cut costs, delay expansion, or in some painful cases, lay off staff. Workers whose retirement accounts took a hit push back their planned retirement dates. Financial anxiety, once a private worry, becomes a dinner table conversation in households across the country. Sarah spends her evenings not just working, but talking friends and neighbors through what any of it means. She explains that a bond market sell-off isn't some abstract Wall Street event. It reaches directly into mortgage rates, credit card costs, car loans, and business financing. It touches nearly every corner of daily financial life, whether people realize it or not. Weeks pass, and the initial shock slowly fades into a longer, harder conversation about fundamentals. The underlying issue was never a single overnight event. It was years of large government deficits, rising debt levels, and growing interest costs finally colliding at once. International monitors had been warning about this trajectory for months before the crisis hit. Reports highlighted that global public debt was on pace to exceed the size of the entire global economy within years. They specifically flagged the United States for running deficits far larger than other advanced economies. Warnings noted that heavy borrowing pushes up interest rates, not just domestically, but around the world. When the country issuing the world's reserve currency runs persistent, large deficits, the ripple effects reach everyone. Higher borrowing costs in Washington eventually mean higher borrowing costs in Frankfurt, Tokyo, and Sao Paulo, too. Policy analysts stress that addressing this isn't a quick fix. It requires years of disciplined fiscal choices. That means difficult conversations about spending, revenue, and entitlement programs that few politicians want to have. The warning from these institutions is consistent and blunt. The window for making these adjustments in an orderly way is narrowing every year that action is delayed. Delay doesn't make the problem disappear. It simply raises the eventual cost of fixing it. Back on trading floors, a new phrase starts circulating among analysts and strategists. They call it a structural repricing of what a safe asset even means in this era. For decades, Treasury bonds were treated as the closest thing to a risk-free investment on the planet. This crisis forces investors to ask whether that assumption still fully holds. Some conclude that Treasuries remain the safest large-scale asset available, just with more volatility built in. Others argue investors need to permanently build more diversification into their portfolios, including gold and other currencies. Financial advisors nationwide begin updating client strategies to reflect this new, more uncertain reality. The old assumption that bonds always rise when stocks fall no longer feels guaranteed. That assumption used to be the backbone of balanced portfolio strategies for millions of everyday investors. When it breaks down, even conservative, cautious savers feel the effects of a much riskier world. A full month after the initial shock, markets have not fully healed, but they have stabilized. The Dow, the S&P 500, and the Nasdaq have clawed back a portion of their steepest losses. They remain below their pre-crisis highs, carrying the scar tissue of a very rough month. Mortgage rates, while still elevated, stop climbing and settle into a new, higher normal range. Sarah starts seeing buyers slowly return to the market, adjusting their expectations to fit the new rates. Smaller homes, longer timelines, and more cautious budgets become the new standard for many families. Small businesses that survive the credit squeeze begin cautiously rebuilding, watching every dollar more closely than before. Consumer confidence ticks up slightly but remains far below where it stood before the crisis began. Economists describe the recovery not as a bounce back, but as a slow, uneven climb. Gold, having spent the crisis setting fresh records, holds most of its gains even as broader panic fades. Analysts describe it less as a temporary fear trade and more as a permanent recalibration of how investors think about safety. Central banks that had already been buying gold for years continue those purchases. Unfazed by the higher price, the dollar's role as the world's dominant reserve currency doesn't disappear, but its dominance feels a little less absolute than before. Foreign governments quietly continue diversifying a portion of their reserves, a trend that had been building long before this crisis hit. It is a gradual shift, not a sudden collapse, but the direction of travel becomes harder to dismiss after this episode. Mortgage brokers like Sarah adapt to the new normal, coaching clients through a market that looks nothing like it did a year earlier. Some buyers get creative, choosing adjustable rate mortgages or larger down payments to soften the impact of higher fixed rates. Others simply wait, renting a little longer while they save more and hope for a friendlier market down the road. Homebuilders shift their focus towards smaller, more affordable floor plans to match what buyers can actually qualify for. Small businesses that survived the credit squeeze lean harder on non-bank lenders and alternative financing options. It isn't always cheaper, but for many owners, it becomes the only realistic way to keep their doors open. Central banks continue monitoring funding markets closely, ready to step in again if stress resurfaces. Officials publicly acknowledge that the plumbing of the financial system held, but only barely. Privately, many admit this was closer to a full-blown systemic crisis than they are comfortable saying out loud. Reports commissioned in the aftermath point to the same root causes over and over again. Persistent deficits, rising debt service costs, and a shrinking pool of reliable foreign buyers for government debt. They also point to a newer, less discussed risk, the growing role of highly leveraged non-bank investors in the bond market. These players can amplify sell-offs by rapidly unwinding large positions under stress, exactly as happened this time. Regulators begin pushing for reforms designed to make this corner of the market more resilient going forward. Whether those reforms move fast enough before the next shock remains an open question. Lawmakers in Washington hold hearings, questioning officials about what went wrong and what needs to change. Some push for immediate spending cuts, arguing the deficit itself is the root cause that must be addressed first. Others argue that cutting spending too aggressively during a fragile moment risks tipping the economy into a deeper slowdown. Economists across the political spectrum agree on one thing, even if they disagree on the solution. The path the country was on before this crisis was not sustainable indefinitely, and everyone privately knew it. Rising interest costs on the national debt had already started competing with other government priorities for funding. Every dollar spent servicing old debt is a dollar not spent on anything else, a simple but powerful truth. International observers had flagged this exact dynamic for months, warning that debt servicing costs were climbing faster than the economy itself. They noted that heavy government borrowing in the world's largest economy doesn't stay contained within its own borders. It pushes up the cost of borrowing for governments, businesses, and families everywhere else in the world, too. That interconnectedness is part of why an emergency call among finance ministers felt necessary within hours of the initial shock. No single country could fix this alone, and every country had a stake in seeing it resolved. Sarah, sitting at her desk months later, reflects on what she lived through. She realizes the crisis was never only about numbers on a screen. It was about trust, and how quickly trust can crack when enough people start doubting it at the same time. She thinks about the calls she took that first week, the fear in people's voices, the disbelief. She thinks about Robert, the retired teacher, and how shaken he sounded checking a retirement account he'd trusted for decades. She thinks about the small business owners who couldn't get a loan through no fault of their own. None of them caused this crisis, yet all of them lived through its consequences in very personal, very real ways. That, she realizes, is the part that never makes it into the headlines or the market recaps. The story isn't really about basis points, yield curves, or auction results, even though those are the words used to describe it. The story is about a bakery owner missing a payroll, a young couple postponing a wedding, a family delaying a home. It is about millions of small, quiet decisions being reshaped by forces most people never see and rarely understand. The bond market runs on the belief that a government will always pay back what it owes. The stock market runs on the belief that businesses will keep growing into the future. Even the housing market, in its own way, runs on the belief that a monthly payment made today will still be affordable tomorrow. Take away enough of that belief all at once, and even a technically sound system can look like it's failing. That's the uncomfortable truth this crisis exposes, that confidence isn't a soft, secondary factor in finance. It is the load-bearing wall. Numbers on a spreadsheet don't panic, but people do, and people are the ones buying, selling, lending, and borrowing every single day. The banking system runs on the belief that your money will be there when you need it. When enough of those beliefs get shaken at once, the entire system feels the tremor immediately. History shows that these tremors, while frightening, are rarely permanent if handled with coordinated, credible action. Central banks stepping in, large investors buying the dip, and governments acknowledging the real underlying problems all play a role. None of it happens instantly, and none of it happens without real pain along the way. Families lose money, businesses struggle, and confidence takes time to rebuild. But history also shows that panic eventually meets its limit, and patient capital eventually steps back in. The lesson from this entire episode is not that the financial system is fragile beyond repair. It is that the financial system runs on confidence just as much as it runs on capital. When that confidence gets tested, the response of leaders, institutions, and everyday investors determines how deep the damage goes. An emergency triggered by a bond market sell-off and a Wall Street meltdown brings real consequences. Higher borrowing costs, slower growth, tighter credit, and a genuinely uneasy period for households and businesses alike. But it also brings a reminder that markets, however chaotic in the moment, have weathered shocks like this before. The real question moving forward isn't whether another shock will eventually come.